Welcome to Green Money Matters, the podcast where your financial future meets the planet's well-being, bringing you the latest on climate issues and uncovering new and exciting investment opportunities that make a positive impact.
And I'm Chris Everett, your guide to sustainable investing, ESG funds, and all things green. Each week, we'll explore the intersection of money and sustainability, showing you how investing wisely can create a greener world and grow your money.
From renewable energy projects to eco-friendly startups, we'll dive deep into the companies and funds that are driving change and making a difference. Whether you're a seasoned investor or just starting your journey, Green Money Matters is here to empower you with knowledge, insights, and actionable tips that'll supercharge your portfolio and make a positive impact on the planet.
Join me as I speak with industry experts, successful investors, and thought leaders who are shaping the future of sustainable finance.
So get ready to invest with a conscience and join the growing movement of individuals who are reshaping the financial landscape. Welcome to Green Money Matters with your host, Chris Everett.
So today we had Uli Epensberger with us in today's podcast. Uli is a mountaineer, he's a skier. We spoke a lot about the impact of climate on things like skiing, on mountaineering, and the mountains near where he lives in the southeast of France. So Uli gave us some really terrific insights about what impact investing actually is, how to go about it, how to make positive change through your investments, and what difference it can actually make. And we had some great insights into greenwashing in particular, who's climate mindful, who isn't, and maybe some tips as well about where the money is going. So over to Uli. Today we're going to be looking at impact investing. What it is, what difference it makes, and how we go about it. And I'm very fortunate to have Uli Epensberger here. Uli's the co-founder and CEO of Ziggma. Prior to this, he was a co-founder at Gustavo Gusto and has worked for some 16 years as an analyst and portfolio manager for some of the world's leading asset managers. Uli is a fervent advocate of value-based investing, particularly when it comes to climate change. Uli, welcome.
Thanks for having me, Chris. Nice to have you.
Yeah, pleasure. So, Uli, perhaps just to further introduce yourself, you could tell us a little bit more about Ziggma, why you founded it, what it does, and why it has two G's in the middle.
Yeah, nobody's ever asked me that question, but it's a great question. Look, I mean, the way where Ziggma was started was to solve the problem of portfolio management for self-directed investors. Keeping up with your portfolio is very, very hard unless you are a spreadsheet, fanatic or expert or a coder. But for most people, it's hard, right, to keep up with your diversification, to keep up with how your portfolio companies are doing, how to make your portfolio better, which is the ultimate goal for everyone. And having invested for over 20 years also on the private side, on the personal side, I got fed up with the lack of tools there is out there. And I decided to, found Ziggma and, build a solution myself. And from the beginning, the idea in my head was to help investors, self-directed investors invest better. And that means return and impact, right? And sustainability. That's what Ziggma is all about, solve for return and impact.
I mean, I've had a look at it, and it's so interesting, and I love the way you've built sort of different strategies around it, and so that users can take on a Warren Buffett strategy or all sorts of different things. How exactly did they go about building a climate relevant or impact targeted portfolio? How does one start?
We make it very easy because we use data. We thought a long time about, buying ESG data from the usual suspects. But we quickly came across, the many obvious or well-known shortcomings, which is that, between the top 3 or 4, they don't even agree on the methodology. It's a lot of, qualitative information in there. I know how the rating agencies work, and I guess those organizations as well. It's very subjective, and we are data-driven, purely data-driven. So when the EU taxonomy, was announced early 2022, we got really excited and said, yeah, now we can use data for emissions. And it was a little bit harder than that, but now there are outfits out there that give you that emissions data. And now what we can do is we can look at what companies, we could look at companies' track records to tackle emissions, and which reflects that they're actually doing something. And so that's the past, and then the future is the net zero target. So we take those two things together and we produce a climate score on a scale of 0 to 100. So to answer your question, if you go to the Ziggma stock screener, there is one sliding scale that says Ziggma climate score, and you screen by climate score, and then you whatever you want to put it at, 70, 80, however small or big your universe, your choices you want to be, and in one screen or in one setting, you have the best companies by climate action, and it's purely data driven. So there is no offsetting, there is no greenwashing. It's just what they have done and what they plan to do in the future, and that's so it's data driven. That's what we're all about. And and then you have the climate bits there, and then you can obviously do your traditional stock screening where you look for growth, value, dividends, whatever is important for you.
So I was fascinated by this your climate score approach. How does that stack up against more sort of typical use of ratings agencies like Moody's or Sustainalytics?
Yeah, we get different results. I can give you a very good example. I guess two really that are a little bit bothering me quite a lot. One is Microsoft, which gets very good ratings from most of the rating agencies. Let's call them rating agencies, but we're talking about Sustainalytics, we're talking about MSCI, but knowing rating agencies really well myself from my professional career, I have a pretty good idea of how they work. And so it's very qualitative. And in the example of Microsoft, Microsoft makes this claim that by 2030 they will be emission neutral, and by 2050 they will have sort of eliminated all of the emissions they've ever put out into the atmosphere. Now, if you look at the data and the track record, their emissions is going up big time, and even their carbon intensity, which is emissions divided by revenue, is going up as well. So you could say, well, Microsoft is growing, in the low double digits. It's growing its revenue, it's growing its business. So naturally, emissions are going up. But even emissions per dollar earned are going up. So they talk a really big game, but the actual deeds, there is not much to give them credit for. And another one is Next Era, which is the biggest utility by market cap in the United States. They also do a really good job marketing what they're doing. But if you look at their carbon intensity, they are, I think, the third or fourth dirtiest utility out there. So yes, they may have big plans, and you should give them credit for that. But I think what's important now with the urgency of climate action to act today or now, I think people overlook the fact that, what have those companies been doing over the last year, 2 years, 3 years. And that's what we do with the emissions data that we have. So we buy emissions data for the last 3 up to 5 years, depends on how big the company is. And we factor that in. What has the company actually been doing?
I mean, that's so interesting, especially about Microsoft. So how do you I mean, how effective would you say your climate score approach is at stripping out the greenwashing, the big talk?
I think it's 100% effective because we're looking at, their emissions only. They are self-reported for the most part, right? If they're not self-reported, our data provider estimates them. We chose them over some others based on their methodology because we think they have a really good methodology in terms of estimation. So just to give you an example, Amazon, for example, which is a retailer, but also, a cloud provider, they don't just say they are a retailer and then they estimate based on their emissions based on what's going on in the retail space. They actually break down the revenues to really get a better estimate and look at, how much revenue is from cloud and how much revenue is from retail and how much, revenue is from something else. And we picked those providers on that. And I think they're doing as good as a job as they can and the best based on our due diligence of what's out there. But yeah, as long as the companies self-report, we obviously take their own data and simply look at whether they have been cutting their emissions.
Yeah, understood. Now, I come from the coast of North Norfolk on the east coast of England, where it's so flat that we get vertigo when we climb into bed at night. Now, you're a ski mountaineer, I believe, so that presumably means you actually, climb mountains and then ski down them?
Yes, that's something I love to do with my skis or without my skis. I try to go outside as much as possible, within the small mountains that are in my proximity. So I'm not someone who's, been to the Himalayas or something. So, ski mountaineer sounds very super exciting, but, I just, go out for half a day, whatever, climb up, ski down. And that's something that is very important for me.
So what is it about the danger and the freezing temperatures that appeals to you?
Oh, there is not much danger. You have to, if you make sure that you don't go out there when, there's been a lot of snow recently, when the conditions are, temperatures are changing a lot. You got to look at the slope. You don't go into places where the slope is too steep, which exponentially increases the risk of avalanches. I have 3 kids, so I do try to minimize the risk, and I think I don't have like I said, I don't have huge ambitions in terms of ski mountaineering. So a mountain for the everyday mountaineer, ski mountaineer is just fine for me.
Okay, brilliant. Now, I mean, you're out in the mountains. Skiing and snowing has been in the news a lot recently in regards to climate change. What have you seen? What climate changes have you seen?
Yeah, so where I live, so in southeast France, we've gotten some huge heat waves over the last couple of years, which I guess many places in Europe have. And, I have a little hill where I go down when I pick up my kids from school, and and I go by bike, and there were days when it was just feeling like, cycling in a hairdryer, right? So that really gives you a reality check. When you drive up into the mountains, you see, pine tree, whole patches of pine trees just going dead. So that gives you a reality check, almost daily of what's going on. Not to speak of, the low snow cover, which you can argue, that's always been there, right? That it's been volatile, but glaciers, trees dying, and extreme heat waves. That that's really something that it's present in my mind.
Yeah, I mean, absolutely. I mean, do you see a point in time where skiing is becoming or going to become a very rarefied sport?
Yeah, it's people are already talking about it here where we live. There is a bit of we're just outside the mountains, but so there's a there are some people that go back and forth and that live from the ski resorts, and when you have we go to a party or a get together, people talk about it, and the talk is that in 10 years or 20 years, skiing will only be possible in the Alps and the very high altitude resorts, which will make it ever more confined to the privileged and the wealthy, and ski resorts are already closing down, smaller ones in lower locations and lower altitude locations. I know a couple that are already closing down because they don't get enough snow.
Mountaineering as well, I guess, becoming a much more sort of dangerous
thing. Yes, you're going to have to go much more above the tree line, and into higher up into more exposure. Definitely.
Yeah. So what does impact investing mean to you then? How can we use this to meaningfully and positively affect the environment?
Yeah, look, for me, there are two things, right? One is that we give our users two possibilities that can both be combined, so they're not, exclusive. One is, as I was explaining earlier, the possibility to screen for companies or stocks by using our climate score or even carbon intensity, whatever. So if it's a preference to invest in companies that are progressing very well in tackling climate change, you can do that by using high scoring companies on our climate score. Or if your preference is to invest in companies that have a low carbon footprint, you can do that as well, because you can screen by carbon intensity. So that's the one thing where we help you direct your investments based on your preferences when it comes to climate change and emissions. The second thing is that personally, we think that you should not necessarily divest from the companies that you invest in, but you should be an active shareholder. So what I'm talking about here is engagement. So only 11% of private investors in the United States actually vote their shares. So there's a huge scope. So let's say there's 18 million, individual shareholders in the United States, according to FINRA. So that means we're talking about a little more than 8 million people that actually vote their shares. So you can imagine the engagement upside that is possible, and we strongly argue for people to vote their shares when there is an ESG related matter on the proxy voting statement. So we fully understand that people are not necessarily motivated to vote when there is just the election of the directors whom they don't necessarily know, and the auditor, but there's an increasing number of ESG related resolutions on those proxy statements, and we encourage every stockholder for stock in question to vote their shares, and that's hugely important. And what we do there is when our users link their portfolios to Ziggma to manage them better and for the long term, we know what stocks they hold, and if they opt in, we can send them actually a gist, what we call a gist, an email with a small informational note about about the resolution, and tell them, hey, you should look out for the proxy statement being sent out by your broker, and this is the resolution that's on there. If you care about climate change, please vote. Right?
That's excellent. That was going to be my follow-up question. It's like warm words about encouraging people to be active shareholders, and how do you go about that? But you actively engage with them via the platform. That's brilliant.
Yeah, we ran a survey, and the motivation of our users to actually vote their shares is quite tremendous. So we sent out, a question whether they wanted to be notified about these resolutions, and 80%, of responses said yes. And we asked them also why. So why don't you vote? And basically as you would expect, they say, well, we don't know when the proxy voting goes out. It's like this anonymous email from a broker, which is one of 200 emails that I get every day. So I don't know. And then even if I see it, I don't even know whether it's worth my time, whether there's an ESG related resolution on the proxy statement. And that's where we come in. So we remind them of the fact that the proxy voting is going out. So the email comes from Ziggma. And, in that email, we tell them, hey, if you're an Amazon shareholder, please note that there is a resolution that's asking Amazon to provide greener investment opportunities for their employee pension plans, for example, which is not a random example, which is a real life example from a couple of weeks. That's actually, I think, outstanding right now.
Excellent. Oh, that's fantastic. On a big picture, how much impact, how much effect, what sort of outcomes can we expect by taking a much more climate-centered, impact investing approach?
It depends on which sort of approach you're taking. So something that gets me, fed up as well is what the banks are currently selling you, which is, these low carbon portfolios. So you will find, I don't know, in their Accenture or companies that don't have, production sites or that produce no products, just services, and companies will sell you, and the banks will sell you that, saying, hey, this is a really low footprint portfolio. Great, you can feel good about yourself. Well, I don't think that's going to solve our problem, right? I mean, we all need our utilities. We drive around, we fly around. Well, hopefully not too much, but we still are mobile, right? So we think that you should basically invest based on your financial criteria, and then and then look at what the company's doing, and if it's really a company that doesn't care at all, then you can take two approaches. Either you divest because you just can't, you just don't feel comfortable with it, or it prevents you from sleeping well at night, or you make sure that you never miss an ESG resolution on that company, and that you vote your shares, and maybe even write to the company and say, hey, look at your competitors, they're all doing something, you're not, please change your ways. I think with that we can have a lot of impact. There are startups out there that are actually targeting the companies to engage with the shareholders. So that tells me that the companies are mindful of that, and do care about what even the individual shareholders do. And then finally, maybe, and that's also a very important point, is that we see that with our users. Some of them said, well, it doesn't really matter whether I vote. That's not true at all, because if you think about shareholder ownership in three categories. One is the institutionals, so your mutual funds, your investment managers. That's the first category. The second category is ETFs, which is basically just rules-based. And the third category is private investors. So going back to the first category, institutional investors, they have a conflict of interest, right? There's portfolio managers. What are their KPIs? Well, it's performance. The share price needs to go up, ideally within the year, by year end. And for their employer, the AUM needs to go up, right, which is related to the share price. So they are really conflicted when it comes to a company deciding whether to take $1 billion for a share buyback or to invest it in sustainability, right? The second category is ETFs. They generally vote with management. I don't know if you've seen there were, on Apple, there were 5 ESG related resolutions, and the board recommended to vote against all of them. So the ETFs naturally vote against. And it's a big category. That's like 30% of the entire market. I think institutions are also a little bit 30 something, and private investors are also 30. It's like 1/3, 1/3, 1/3. So if you consider that 2/3, are not exactly well positioned to vote, sustainably, then it makes it all the more important that private investors vote.
Yeah, absolutely. I mean, that's a sizable chunk of impact right there. What do you see as the future for ESG funds in general?
Oh, that's a tough one. Look, we've steered away from ESG, so I haven't really kept up with it all that much, but we've spent a lot of, so I'm not really well positioned to talk about what's been happening over the last 6 or 12 months, but I guess things are not moving that fast anyhow. But what we found was that something that I think, personally, I think that works against, ESG as a, determining factor on how to choose stocks is then when I think back towards certain platforms that have like a spider web where you have like 30 ESG factors, and no single company can be furthest out on all of those KPIs, right? So you end up having to make a trade-off between 30 factors which normally we all care about, right? So how are you going to weigh all these things with our limited human mind? And so that's when you're doing stock picking yourself. So that's where I see that problem. So what I would say is that when we decided to focus on climate rather than ESG, we said you can only pick one fight or maybe 2 fights max. But we cannot master all of these ESG subjects. So that's my point of view on ESG when you do stock picking, and then you enter. So that then you could say, well, then you just take the main grade. Well, you could, but then again, as I was saying earlier, Microsoft could be a D with one provider and an A with another provider, and it's across all of these companies. It's like that. And then you could say, well, then just invest in ESG mutual funds or funds. But we all know that banks have these inherent conflict of interest, and LIBOR, FX, subprime. There are so many examples whereby let's say the eagerness to sell overtook, I guess, all principles, and I think that's what happened in ESG as well.
Yeah. So is what you're saying then that there is kind of an actual fact a conflict between social and governance issues and environmental issues, or that these other factors, social governance factors, just kind of skew the whole board so much that one should just focus on climate?
No, I'm not saying that. I think it's definitely there's an inherent relationship, and I think it's positive, right? So good governance normally also manifests in good environmental policies. I think one good example is a beginning trend towards tying CEO pay to environmental KPIs. There is As You Sow, who's very active about that, the not-for-profit founded by Andy Bihar. So really great, work that they're doing there. They've been pushing for that. So, I think Dominion Energy is one of the first ones to implement that. And then As You Sow also looks at whether that, that KPI is actually meaningful, right? If it's not meaningful, then yes, it's there. It's just cosmetics. But so As You Sow looks at that as well. So yeah, usually it goes hand in hand. What I was saying is that when I, as an individual shareholder, want to pick, a stock based on ESG sub ratings, it's very difficult because a company may score a little poorly on, I don't know, equality of women on the board, but score really well on climate change. And I care about both issues, right? So which one do I pick? And that's where it gets really, really complicated.
So where are you particularly, as a market perspective, where are you seeing, momentum happening right now?
I think there's momentum in, shareholder engagement. A lot of people want that. I think there's also a lot of momentum in ESG. Let's call it ESG investing, because, like I said, many people have their one topic that they're particularly interested in, or two topics, and they want to have investment solutions for that, right? So they want to build their wealth, generate return, but they also want to do good, make sure that the money, that where they put the money is actually, ethical or furthering their cause. And I think that there aren't really all that many great solutions out there, right? Just to not be not sound negative all the time. I think one great investment vehicle out there is green bond ETFs. That's something I would endorse, because those are green bonds. So the bonds that are in those ETFs and those fixed income ETFs, they have to be, or the funds that are used for those, I guess, fixed income or bond issuances, they have to be used towards, environmental sustainability. So you have like a clear cause and effect relationship. Whereas, we all know that, in your general sort of ESG fund, you have all kinds of companies in there that are not necessarily, behaving all that well.
Indeed. So, classic question for you. Is there a trade-off between climate or ethical investing and outcomes and growth?
I don't think so. I think there is some academic research that shows that there isn't. Maybe that there's even a positive relationship, and if you boil it down, it makes sense, right? Because if you run your company in an ethical way, then you will attract talent. You will look further out than just the next quarter, the next year, and you will make good long-term decisions, and that I think that's ultimately appreciated by all stakeholders, so consumers and shareholders. And so just from as a non-academic, I think that result from the academic side makes logical sense to me. I don't have any study to quote, but I think it's something that gets accepted generally by the public. And there's actually FINRA studies that go as far as to ask people whether they would accept a lower return if they knew that their investments were ethical and top-notch ESG compliant. And they actually say that there is a good amount of people that say that they would. That's just a survey. So our assumption or premise is that we all sort of need to make sure that we can retire comfortably. So return is important and will come first for most people. So that's why our focus is to solve for both return and impact.
Excellent. Yeah. None of our hopes, none of our dreams can survive the loss of a habitable planet. Hey?
Exactly.
Yeah. Yeah. No, I'm with you 100%. And I think the studies out there back that up. Maybe it's a distraction that people think, if I'm prepared to lose or not get such great growth through ethical or climate funds, then automatically I won't get good growth. But the studies do seem to bear it out that you get on average across the board that you're going to get at least as good returns, or in many cases better returns, purely from a risk perspective, I guess.
Yeah, maybe it's also a matter of, disinformation, because you asked me earlier about, momentum, and there's a lot of positive momentum in the United States, which is our main focus for now. But there's also some negative momentum, with, anti-ESG initiatives. So maybe there is some disinformation, from that side as well.
Yeah, exactly. I mean, I think I'm correct in saying I think that 17 states have now enacted legislation preventing investments in ESG or climate-related funds, at least through state holdings.
Yeah, that's unfortunate.
Yeah, it is unfortunate. What are you seeing in terms of the Ziggma platform? I mean, obviously it's growing. What sort of growth numbers are you seeing? How attractive and interesting is it for investors, private investors?
Well, so far we have seen quite a lot of growth. It seems like there is a real pain point when it comes to portfolio management tools that help you manage your portfolio better and track it better and optimize it. So we've launched a little less than a year ago, and we're going on 25,000 registered users, and we've connected over $1 billion in accounts, brokerage accounts to Ziggma. So we're not managing that money. People link their accounts so they can see their accounts and track their accounts in Ziggma. And, they make their own informed decisions based on the tools and data that we provide. But, we got a lot of people from Robinhood, TD Ameritrade, all, the big brokers, which sort of tells me that, these people aren't happy with the tools that they're getting from those brokers. When it comes to actually, understanding your portfolio, managing your portfolio over the long term. And, I guess there is a little bit of, if you want to analyze that, I guess there's a little bit of, I guess that where I'm going to put my finger is that brokers have an inherent interest to get people to trade, to transact, because that's where they make money, and we don't have that. So we don't care how many times, people trade or transact. All we care about is, to help them understand their portfolio, make sure that they stay diversified, that their risk doesn't run outside of their sort of tolerance corridor, and that they get good information on the companies in which they invest in, whether it's financially or climate impact.
Right, and the growth, the demand for climate related, for climate positive assets, what are you seeing?
There is. So we haven't really found our, I guess, sweet spot in terms of like marketing channel to really get the word out about the products. But yeah, there is some very positive feedback. There's also some negative feedback. People write in, can I use Ziggma without all the woke stuff? Yeah, you can. You can just be agnostic of it. That's fine. Everybody is entitled to his or her opinion. But yeah, to really find that climate mindful crowd, we're still looking for the best channels and the best way to reach these people. The various surveys out there, whether it's Morgan Stanley, More Sustainable Signals, or Boston Consulting Group, confirms that there is material interest out there in both the overall ESG space or ESG principles, but particularly on climate change. But I think once we find that channel, then I think growth will accelerate.
All right, brilliant. And where are you seeing sector growth or industry growth at the moment? what's hot to invest in right now?
Well, I'm always careful with investment recommendations. We're not really in the business of that. We are about portfolio management. Tools to help you understand your portfolio and make good decisions based on your portfolio. We're not really in the business of making like stock pick recommendations. In terms of like, since you needled me, if I wanted to give you a sector that is sort of growing fast, I guess there's always tech. Obviously, you have to be careful these days, and renewables, clearly, whether it's through solar stocks, wind stocks, whereby you have to be careful on the wind side because all the material costs. So I think companies like Vestas are not particularly profitable these days. And ultimately utilities as well, right? So I think utilities have a big role to play. They're not gonna let you they're not gonna double over the next 12 months or so, which is exactly, I guess, what we're about anyway, right? We're about long-term investing. So if I think you can find some good growth stories in utilities, the ones that have the right plan towards the transition. They will be well supported by public funding with the IRA, and they will see strong demand from companies that want to decarbonize. So I think there is that's sort of some ideas for the spaces where to look.
That's very fair and very interesting, Uli. Thank you. Is your platform in the business of actively excluding certain sectors, certain companies, certain industries, or does the screening do that for us?
Not really. So it's open, and like I said earlier, we are about return and impact. So if somebody wants to care about just return, we want them to have a fully operational and powerful platform to achieve that goal as well. So we're not excluding anything. It's really, I guess, just a positive sort of approach whereby if you want to screen by climate impact, you can. If you want to set a notification alert to be notified when there is an ESG resolution on a proxy statement on any of the stocks that you own, you can do that. But yeah, we don't exclude anything or call out anything.
Okay. And where is Ziggma going? Your focus at the moment is to a larger extent on US stocks or North American market. What does the future hold for you?
We are continuing to focus on the US market. It's a very big market. We're only getting started. Where we're going in terms of product is more broadly into wealth. Optimizing the tools that we already have to find what's not going right with your portfolio, where can you do better, what are better alternatives, based on, I guess, your profile and things like that, so that all the people that want to do that entirely digitally have the best I guess platform available to do that. So we have more of a product roadmap to execute on than a geographic roadmap right now.
All right, excellent, understood. So Uli, thank you very much indeed. That was a tremendous insight into impact investing and how retail investors can go about it and do so in the most climate focused way possible. It's a terrific insight. Thank you very much indeed. Today we've had Uli Epensberger with us from Ziggma with 2 Gs. Thank you very much indeed, Uli.
My pleasure. Thank you for having us.
If you enjoyed today's episode, be sure to subscribe to Green Money Matters on your favourite podcast platform and never miss an opportunity to grow your wealth sustainably. Together, let's make money matter for the planet.
And don't forget to leave us a review. We really would love to hear your thoughts or ideas for future episodes. Drop me a line by email at chris@greenmoneymatters.com.
Stay tuned for our next exciting episode, where we'll explore groundbreaking investment opportunities and unveil the secrets of successful, sustainable investors.
Until then, remember, green money matters because investing in our planet's future is the smartest investment choice you can make. Thank you for joining us. Until next time, goodbye.